Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to see what people are sharing on Twitter, social media. This is where I like to interject my financial opinions as we go through it. It's going to be related to three topics. Generally, it's going to be commodities, wealth building, and/or financial topics that we'll cover in this clip, and we'll dive right in and see what people are talking about. If you want to follow me, it's at @finding_finance, and if you want to join our community, finding-value.com. We do have a discount going on towards the end of December is when it will, actually beginning of January is when it ends. Holidays is the discount if you want to check it out. So first one is such a powerful chart. Yes, no one likes inflation, but it is drastically slowing while incomes and compensation are growing more. They don't tell you about this on TV, but it is a big reason we don't see that mild recession all the institutional shops are promising. So rate cuts are coming into a strong economy is what he is talking about. And we've got disposable income up 4% annualized. Employee compensation is up 5%. And PCE inflation is 1.4%. So real personal income X government transfers is about 4%. So that is actually a good thing. That disposable income is rising quite substantially alongside employee compensation. JC Parrots, he says, historically, industrials are the sector with the highest correlation with the S&P 500 and of all S&P sectors. It's also a very diversified sector with no stock representing more than 4% of the entire index. And it's making new all-time highs. Is that bullish or bearish for equities? It is bullish. So we are breaking to new all-time highs in the industrials, which is good. This is good evidence or good indications that the economy is, in fact, strengthening. Or maybe not the economy, at least the stocks are strengthening. I'll put it that way. And we're making new all-time highs. That is bullish. Starting out, your portfolio typically grows the most from your contributions when you first start out. But as it gets larger, it starts to grow more from gains and dividend reinvestment. The first part is the hard part. The second part is where things get really fun. I've already crossed. I've crossed that threshold already, and you'll know when you cross it. In the beginning, all you're doing is you're contributing, and your gains may not be as big as your contributions. It feels like you're not really making good progress. If you get a couple of really big returning stocks, then your portfolio dramatically changes. And the majority of the gains come from the gains, not the contribution. For me, that that started. I'm trying to think of like a dollar amount. I think 100 grand is a really good spot. Like that's kind of a good line in the sand. 100 grand. I think 100 grand and more, you really start to notice your gains. If you get like a 20 or 25% gain, that's $25,000. That's a big chunk. And if it just grows from there. So I would say the first 100 grand is probably rough from a psychological standpoint because it feels like everything you're throwing in there is contributions from yourself and not so much the gain. So if you've got like $10,000 or $20,000 in there, you get a 20% gain. It's like, $4 grand on 20,000. It just doesn't feel as big. It's not as psychologically rewarding, I'll say. Oil is historically cheap, priced in gold. This guy is talking my language. The historical long-term average gold to oil ratio is 16. 15, 16 is where I look at it. It's currently at 28. So if we were to go back to the historical ratio of 16, price of West Texas Intermediate oil should be $129 plus geopolitical risk. As your price of gold goes up, your valuation of commodities goes up. It's basically repricing all of your commodities to a higher level. I think that's why a lot of people don't want gold to go higher, is because it's going to reprice all of the commodities higher with all these different ratios. So right now, an average price would be $129 for oil. We are at a very cheap price today for oil. Gold, it's time, and he's got these fractals here. I thought these fractals were pretty cool. You can see today you've got kind of like an inverted shoulder, head, shoulder that developed, and a neckline. Shoulder, head, shoulder, neckline, and then the break in 2010. We've got in 2020 kind of a shoulder, head, shoulder, and then the break. And then in 2007, we've got a shoulder, head, shoulder, and then the break here to the upside. So very similar fractals for today versus a lot of these in history where we've had pretty big runs in gold. This is IsoEnergy. This is a uranium explorer / developer. It's kind of in the middle of that. Big pull with a flag pattern. And what I look for is the big green candlesticks and the small red selling pressure. It exhibits those traits where this could easily go higher. It looks very good for IsoEnergy. This does not look like a topping pattern. It looks like it looks to me like a continuation pattern to the upside for ISO. And here he's got Fission Uranium. Casper has got Fission. What I do is I go off the closing prices. So I'm much tighter here, and I would say it's already broken to the upside. He's going off of where it traded mid-week or mid-month, because this is a monthly. He went where it was traded mid-month. I don't use the monthly candlesticks like that. I go off the closing prices. And you've got more contact points if you contact it here and here. And that would then have broken out already to the upside for Fission Uranium. I was looking at this. I didn't know what CEF is. I'm like, what the heck is CEF? But I looked at the chart and I'm like, this chart looks really good. It's squeezing up, ready to break. So what this is this is a combination of gold and silver. And it's squeezing up. And I'm like, man, this thing looks fantastic. I mean, this thing's ready to break to the upside here any second. So that's the Sprott Physical Gold and Silver Trust. Looks very good. Very good. This guy wrote, you got 45 minutes to spend $10,000 in one store tonight. Where are you going? I would go to a store that sells tires and car parts. That's where I would go, and I could spend $10,000 in 45 minutes. I'd get a couple sets of tires. I need a couple of sets of tires for my cars. I could easily get 3 sets without even thinking about it, maybe even 4 sets. And then at 4 sets, let's say they're about $1,000 each. That's $4,000. I've got $6,000 left. I would buy probably maybe a new helmet, and then I would buy maybe some parts. Get some parts. Equities are expensive. Commodities are generationally cheap. Do with this as you wish. And this is an updated chart that we haven't looked at. This is the S&P Commodity Index versus the S&P 500. And commodities are still ungodly cheap down here. Such a good opportunity. It almost looks like a shoulder, a head, and a shoulder with a neckline going across. That's an inverted head and shoulders bottoming pattern that we're putting in. And right now we're putting in the right hand shoulder. If you're looking at it, it's our right hand. So here's one shoulder here, the head, and then the other shoulder that we're putting in, and then the neckline that goes across. There's a lot of inverted head and shoulders in a lot of different commodity stocks. Energy service has them, oil and gas has them, gold and silver. They're all over the place. Hey, the best laid plans of mice and men. It says no one wants to buy used EVs, and they're piling up in the weed-infested graveyards right now for used electric vehicles. This is going to get kind of interesting because as the car gets older and the battery cost is a lot more than the price of the car itself, or if the miles are high on it, we could be setting ourselves up for a lot of trash. It very well could be. Here's the spec net position in crude finally turns positive. Well, that's good. I know the price has been moving up. I did purchase here some positions in the energy space. And to me, it looks like we're getting in some sort of bottom here. So hopefully we bottom and start moving on up. And the oil speculative net positions are correlated to the price of oil. Uranium. So let's go into this one. In 2007, near-term producers were trading at a forward PE of 15 to 25. That was in 2007. Can you imagine what type of valuations these developers, near-term producers, might have when uranium is trading between $200 and $500 a pound? So they had a forward PE ratio of 15 to 25. So he says, hypothetically, a company with 3.5 million pounds of annual production, 3.5 million pounds of annual production times $200 per pound hypothetical profit times 25 forward PE equals a 17.5 billion market cap. And I don't think anyone is thinking about valuations in that way. And some of these companies, they're going to be producers during this bull market. And when you become a producer, your earnings explode if you have very high uranium prices. So some of these companies, if they get into production, they're going to get re-rated, where they're going to get re-rated to what they're selling per year, their cash flow that they're creating and making. And then all of the pounds in the ground are going to get revalued higher if they are a producer. So keep that in mind, guys. Hedonic adjustments to the oil price. I think we already covered that one. All right, so let's go through uranium to the uranium ratios, because I find this kind of interesting. They look so good right now for the uranium spot price, at least, against other asset classes. So I wanted to cover this real quick, show you guys what's going on with the ratios here. So this is uranium versus silver. Look at the ripping of this, man. It looks so good for uranium and the outperformance of uranium. We look at uranium versus the S&P 500, just rip into the upside. The momentum, just like we talked about earlier, down, basing pattern, and here we are ripping to the upside. And I think that this is probably a precursor. This is kind of the one of the commodities that is going first. I think we're going to see this across the entire commodity complex at some point. Uranium versus gold. Look at that. Look at that breakout, guys. It looks absolutely fantastic. Big move to the upside there. Uranium versus crude oil. Oh my God, look at that thing, guys. It's running. We broke out of this resistance line and it's just ripping to the upside. Uranium versus copper. Look at that thing go, guys. It is massive. Uranium versus nat gas. That is holding on. It's at a very cheap level for natural gas, but still outperforming for uranium. Uranium versus Dow Jones. We're breaking the last barrier and ripping to the upside against Dow Jones. We've got uranium versus platinum, ripping to the upside. It is outperforming everything. And then uranium versus the M2 money supply continuing to lay down massive moves to the upside against that. The uranium's future pricing is this guy here. And you can see the move, we're at 91.55 according to UX1, and we are bullish and we're continuing to move on up. That pivot point was November of 2016 for the uranium futures pricing, and we are just ripping to the upside. Looks very strong and very good. So that's what I've got for today, guys. Not as long as some of my other clips, but yeah, everything's looking good as far as I can tell. And that's kind of what I've been looking at is uranium and the outperformance against all of the other sectors. It is the leader at this time. So give me a thumb up for the content, subscribe to the channel, subscribe to the website if you guys like. Get that holidays coupon code, and we'll catch you guys later. This is Finding Value.